I'm glad we had this event organized. We know that most countries, they face similar problems when it comes to their pension systems. People are living longer and healthier lives, which of course is good news. We also know that at the same time birth rates are declining, and these two forces combined, they mean that there will be fewer working age people supporting retired population in their old age. So this is putting pressure on publicly financed pension systems. We have questions such as how far can we extend the retirement age? How much should people be relying on income from their individual savings in their retirement? Also, how much should governments encourage or even perhaps force people to save for their retirement? So these are some of the issues we plan to tackle also today. We first had this idea of organizing such a workshop this spring when the IMF was last time in Tallinn, and we were discussing what are the important policy discussions and choices we are debating here in Estonia. There was a clear sense that many people in Estonia, and importantly also the newly elected government, does not think that the existing pension savings plan has been satisfactory, and the government, we knew that is considering options for changing it. Therefore, we thought that it would be helpful to have such a workshop to have an expert-level discussion on what could be improved in the Estonian pension system, as well as, importantly, also to learn from the experiences of other countries. Because, as you know, smart people learn from successes and mistakes of others instead of repeating and trying everything themselves. And so we could, this way, one can, of course, build on what others have learned already. I think perhaps too much of the recent debate on pensions in Estonia has been around emotional arguments about what someone believes to be true or not. So the idea for today is to have less of a discussion about worldviews and emotions, and instead focus on hard facts and experiences from other countries and see how much of it can we use here in Estonia. We're lucky today to have with us experts, first of all, from Hungary and Poland, two countries that have recently fundamentally changed their pension systems. We will also specifically focus on how to best invest pension savings, and we're lucky to have with us experts from the OECD and the Swedish Pension Agency to tell us about best practices in that area. And most of all, I would like to thank Cheikh, Anta, Gueye, our mission chief from the IMF, and Saba Fair, the IMF's best pension expert. The two of you really put together much of this event and helped us identify the best people with international experience to learn from and to invite here. The discussion on the policy choices in Estonia since spring, it has progressed, but I don't think it's too late still to consider what exactly could we or could we not do when it comes to our pension system. The debate in the parliament is only about to begin later in the fall, so hopefully we can still come up with good conclusions that will be helpful also to Estonian policymakers. So with these words of welcome, I would like to give the floor also, Cheikh, to you for some short comments.
Thanks, Governor. Welcome. Dear participant, Tere, time has never been ripe to accelerate reform in Estonia. Under external negative development, the economy is slowing, but growth is still strong, supported by domestic demand. As growth is above potential, wages are on the rise, and unemployment is falling. Inflation is relatively volatile. Public finances are performing strongly. Net public debt is negative, and the current account is in surplus. In that context and sense, the two-day workshop is welcome, and it is rightly circumscribed in the trajectory of helping to think over ongoing reform. As we have experts on the subject coming from different corners of the region and within Estonia, we will not step over their zone, so we wish full success to the workshop. Thank you.
Gives an overview what happens. My name is Agnieszka Chłoń-Domińczak, and I come from Poland. I've been involved in introducing the pension reform in Poland 20 years ago, and I have been following changes that happen in the Polish pension system, but today my role is to lead the session on the overview of the state of play in the Estonian pension system at the moment and its challenges. And we have a very interesting panel when we combine perspective of two ministries and regulators. So there are two main objectives of the pension system: adequacy and financial stability. So I think in this session we will be able to tackle both of them, and we will hear from the Minister of Finance on the pension system proposal. But before that, we will actually hear from the Deputy Secretary General of the Ministry of Social Affairs, Mr. Sten Andreas Ehrlich, on the Estonian pension system objectives and challenges, and also have the regulator perspective. So without further ado, I would like to invite Mr. Ehrlich to present.
Hello and good morning. First of all, let me thank you for organizing this event. Pensions is a topic that has recently been very emotional, very topical, and this is why it's important that we discuss it in such an event. I've been asked to give you a brief introduction to the Estonian pension system, to its objectives, to describe it a bit, and then to talk a bit about its challenges. And without any further ado, I'll start doing that. So when we talk about the objectives of the Estonian pension system, of course they are no different from the objectives of pension systems in other countries. Agnieszka already shortly mentioned what are the objectives. We want our pension systems to be adequate, and we want them to be sustainable. So in Estonian context, the aim of our pension system comes from our constitution, which says that every citizen of Estonia is entitled to government assistance in the case of old age. Nothing more, nothing less. And when we're trying to think, what does it mean? You can interpret it in two ways, and probably both are right at the same time. First of all, we are meant to protect people against poverty. So essentially, in order to do that, you have to redistribute income from those with high incomes to those with low income. There's no other way of protecting people against poverty at this moment. And the other objective of our pension system is to maintain the standard of living through a person's life cycle. So say you had a very high income before your retirement, before you get old, we want you to have as big income as a share of that later on as well. So these are the two objectives we want to achieve. And I guess it's no different in other countries. The interesting part is the challenges in Estonia. And I'd like to cover shortly 4 of them. I'd like to talk about the effectiveness of the system, how good are we at achieving these aims, Secondly, sustainability. Are we able to do it in the long term or not? Then shortly about obsolete schemes. Is our pension system up to date or not? And finally, I have time for that. I'd like to discuss briefly the future of work as well. So about effectiveness. This is a graph about the at risk of poverty rate in EU countries. Estonia is on your far left. So in Estonia, the at risk of poverty rate of people in pension age is the greatest in Europe. And this has changed in past, but not in the right direction. At risk of poverty, or then relative poverty is another term in Estonia, has increased. It doesn't mean that all people in retirement in Estonia would be extremely poor. It simply means that compared to the median income, the pensions are rather low. So this graph essentially shows how many people are there whose income after social transfers is less than 60% of the median. If you look at other graphs that describe the incomes of people in pension ages, they show a rather similar picture. Almost by every graph or every indicator that you look, it seems that the Estonian pension system is not too generous. Why is that? Why is our pension system not that generous? There are multiple of reasons for that. But before that, just to illustrate the last graph a bit more, this actually shows in what people feel as well. So this is a graph from OECD's Risk That Matter survey, in which OECD asks people, what are the biggest threats you feel, or biggest risks that you have in the long term? And then people have to rate them. I've put a red circle around the dot for Estonia and the dot that says financial security in old age. More than 80% of people in Estonia are afraid of their financial security when they become old. And this is because pensions in Estonia are not that high. Of course, if you look at other countries as well, it's one of the biggest concerns in all of the OECD countries. But Estonia shines out as the country in which this response got the most answers. So why is that? 3 reasons. First of all, Estonia simply spends relatively little on pensions. So this graph shows total pension expenditure in euros in 2016. Estonia is the small red column. There are only a few countries that spend less on pensions than Estonia does. These are mostly Eastern European countries with smaller incomes than Estonia has. So, for example, Hungary, Latvia, Lithuania, Romania. Of course, if you take into account the average salaries in Estonia, which are somewhat higher, you would see that as a share of our income, we spend relatively little on pensions. It's probably one of the smallest rates in Europe. And of course, if you spend little on pensions, you cannot pay out big pensions either. So how much do we spend on pensions in Estonia as a share? So it's essentially 20% of your income. The scheme in Estonia is that you pay 33% of your income as social tax, or actually your employer pays it. 13% of it goes to your health insurance, and 20% of it goes to your pension scheme. And this is the reason why our spendings on pensions are that low. Second reason why pensions in Estonia are relatively low. A part of our pension system is, as you'll later hear, in second pillar, or in mandatory forms of private pension. The problem in Estonia is that administrative costs are rather high. There are only a few countries in the world in which the administrative costs used to be higher than they are in Estonia. Serbia, Zambia, and one other country, if I'm not mistaken. And Estonia was the dead last OECD country in the rate of administrative costs of second pillar funds. if you look at the title, I have said our pension funds had some of the highest costs in the world. There have already been reforms to tackle this. These reforms have come into force last year and this year. This picture is likely to change rather dramatically. And I think Märten is probably going to go a lot deeper on this as well. But this historically has been one of the reasons why our pension system has not been effective. At least one positive thing you can say about our pension system is that the distribution of pensions is rather equal. It's a rather narrow curve for our pensions. This means that even though on average the pensions are not too high, at least there are not too many people whose incomes are low. However, this was about to change. So this is a graph from a study from 2016, in which, I'm sorry that this is in Estonian, I couldn't find an English version, in which you can see the ratio of the upper 20% and the lower 20% of pensioners. So the upper 20% is the blue line, and the lower 20% is the black line. And the red line is the share of upper and lower 20% of their pensions. As of right now, the upper and lower 20% are rather equal. But as time passes, it would have changed rather radically. The reason is that until 1998, in our pensions, a rather big share was carried by service, how many years you had worked. But since 1999, what mattered was your wage. So the bigger your wage, the bigger your pension in first pillar. And as salaries in Estonia are rather unequal, and they are coming more unequal in time, that also meant that our pensions in future would have become much less equal as well. And you can draw this graph in a multitude of ways. For example, there's a big gender gap in our pensions as well, because in Estonia there's a huge gender wage gap as well. However, in order to avoid this from happening, a reform is going to take place from 2021. The service and wage components of pension are not going to be there from 2021, but instead there's going to be a composite part of pension that's composed of 50% service and 50% wage. There was a huge debate a few years ago about what this reform should look like. The reform was debated for approximately 5 years, and the main question was, what is the right proportion between service and wage? How do we give bonuses to people for earning a high salary? How do we incentivize them to pay taxes, to declare the social tax in correct fashion? Also, for example, about what is the true aim of the Estonian pension system. Is it protection against poverty, in which case you would want your pension system to be as equal as possible? And to what extent is the aim of our pension system adequacy compared to your previous income, in which case your previous wage should be the determinant? And finally, we struck the balance at 50-50 between service and wage from 2021. However, this decision was made in the context that second pillar pensions are already dependent on wages. And this is what differentiates the people with higher incomes and lower incomes. This is a part of the second pillar reform or changes that we haven't tackled as of yet, but that perhaps we should ask as well. Given that we have made decisions like this based on the knowledge that we had a second pillar, perhaps we should reopen this debate. It's not something I'd like to do here right now, but perhaps this is a question we should answer. So all in all, Estonian pension system is not doing that well in terms of effectiveness. There's room to improve, and we're trying to work on it steadily. But very little can be done fast in this regard, because every change in pension system is rather costly. The total budget of Estonia is roughly 10, 11 billion euros, and we spend 2 billion of those to pensions. And therefore, even slightest increases in the pensions mean that there's going to be a huge burden on our budget, and we have to find funding for this. This is the reason why before elections, when political parties promised 100 euros of pension rises, it's not that easy to deliver on that. And finally, at least this round of pension increases only came down to 7 euros, because it's simply that costly to increase pensions. Moving on to the second challenge, sustainability. So the problem in Estonia is that, as in many other countries, the ratio of people in working age to the number of people in retirement age is going to fall sharply. Right now, I'd like you to look at the blue line. So without raising our pension age, it would have dropped from roughly 3 in 2016 to less than 2, more like 1.7 in 2060. Why is that? I guess the reason is not too hard to guess. So this is the population pyramid of Estonia in different years. And you can see that in Estonia, as years go by, the number of people on the upper edge of our population pyramid is increasing. The pyramid is starting to look more like simply a column. And of course, this means that the number of people working to the number of people in pensions is going to decrease as well. This is why, with the same reform I mentioned earlier, we try to tackle this problem as well. What we did was that, first of all, we increased the pension age from 2016 to 2026, from 63 years to 65 years, already a considerable change. And then from 2027 onwards, pension age is going to be linked with life expectancy. The more people live, the higher the retirement age is going to be. We hope that perhaps in the future it's going to save us from many very emotional and political debates about what to do with the pension system. There's an automatical mechanism that's going to help us to save the adequacy and sustainability of our pension system. Of course, you had to give something back to the people as well. What we did was that we wrote flexibility into the pension system. So from 2021, it's possible to go to pension 5 years earlier. We call it flexible pension. But that also means that your pensions are going to be slightly smaller. We calculate your pensions if you go to pensions earlier so that they would be neutral in the total sums you get. So no matter when you go to pensions, probably you're going to get the same number of, the same amount of money from the states in total. And the same works when you go to pension later on. So all in all, even though sustainability is a problem, we have tried to solve it. And this is how we got to the red line in this graph. Sustainability is going to be less of a problem than we thought previously. Of course, this also has a caveat. Again, this reform was done in the environment when we also relied on the second pillar. That is not a pay-as-you-go system, but rather a capital-based system that eases the burden on the demographics. And of course, in the context where we're discussing what to do with the second pillar, we also have to look at the first pillar. Does it mean that first pillar pensions are going to be sustainable in the future or not? And this goes especially if we say that with the second pillar reform, we're going to have an increase in first pillar. Because if you have an extraordinary increase in the first pillar, if you're going to make the base part of state pensions higher, it also means that in the future, state is going to have a higher burden of paying out pensions. It's going to be a hit on the sustainability of the system. That doesn't mean that we shouldn't raise pensions in Estonia. It simply means that we should also find ways to cover these costs now and in the future. I promised to also talk about a third obstacle or challenge to our pension system. And this is obsolete schemes. So the problem with Estonian pension system, or one of the problems, is that there are still parts of it that come from the Soviet times. And I have two in mind. First of all, pensions under favorable conditions, and secondly, superannuated pensions. So what are they? They're essentially lists of professions in which you have special rights to pension. They may be that you get to go to pension 5 or 10 years earlier than the normal retirement age. It may also be that if you have already worked in certain professions for a number of years, you get to go to pension earlier. So in Estonia, there are some people that go to pensions when they are 40. And many people that go to pensions when they are 55 or 60. The system really stems from 1950s, when in the Soviet Union there were lists of people who were working in either fields that were hazardous by standards of that time, or in which you simply couldn't work after a certain age. So for example, you wanted your policeman to be physically fit, and therefore you couldn't allow a police officer who was in the 60s to work. So schemes like this. There are 3 problems with this. First of all, the lists are simply outdated. Here I have taken out a few pictures from the archives of Estonia. You can guess who are the people working on these pictures. These are the people, or these are the professions in which we say that you have a special right to pension. Of course, many of these professions do not exist anymore. We haven't reviewed the list at all. It creates many injustices in the system. So for example, in the Soviet times, when you worked in a profession like this, it also meant that you paid a higher social tax. As you contributed more, it was just that you get more money out of the system as well. Nowadays, social tax in Estonia is equal for everyone. There are no differences in social tax. This begs a question: why should it be that some professions have higher or better pension rights where they do not contribute more to the system? And of course, I can agree that there are some areas in which, or some professions where working is very hazardous, but perhaps there should be some other compensation mechanisms to deal with it. Perhaps they should have higher wages. Perhaps we should invest into occupational safety. For example, for long there have been demands for occupational insurance schemes that are not existent in Estonia. Perhaps this is a solution that would be more just. Secondly, there are many possibilities of abuse. So let me tell you a secret about the Estonian pension system. So one of the professions that is in the list is being a parachuter, because this was a hazardous profession. However, as of right now, Estonia does not have parachuters anymore. However, you have to somehow interpret the meaning of the name in the list. And so for nearly 30 years, the interpretation has been that if you are an instructor of parachuters, you're a parachuter. And you become an instructor of parachuters if you do 10 jumps a year. So if you want to retire 5 years early, do 10 jumps a year. This is a small secret I'd like to share with you. I hope that not all of you are going to use it, because then the sustainability of our system is going to fall a bit. But this is an illustration of possibilities of abuse in our system. It's not the only case like this. The lists are full of professions like this. This is the second reason why I would like to reform the system. Third reason is simply that it has high costs. And the costs are going to balloon. So the orange columns are the costs in status quo, and the blue columns are the costs if we would reform the system. As of right now, the system costs us more than 40 million euros per year. By 2060, it's going to cost more than 100 euros per year. These sums might seem small, but if you divide the sum we are talking about between all the people who have retired in Estonia, each and every one of them would get more than 100 euros every year from the system. So essentially, this would be one way to increase the sustainability of our system. This reform has long been talked about. There have been many proponents of the system, many people who are against it, but hopefully we're able to do it in the next few years. The last problem I'd simply like to highlight here, and with a question mark, is what the future of work is going to mean for the system. What's going to happen with the pension system with more and more people working in Uber, Volt, or say Amazon Turk? This is up for discussion. We do not have any answers. But perhaps this is also another matter that we should discuss when we are already opening our pension systems. With these words, I'd like to thank you and wish you a good day. Thanks.
Thank you very much. That was a very extensive presentation with all of issues and problems. And I must say that many of those are really shared internationally, including also the future of work and the gig economy, with a lot of work of recently published report by the OECD or the World Bank that are dealing with the issue of how to manage the pension systems in the changing economy and the changing nature of work. One of the issues that were tackled in the presentation is the performance of the funded pillar, including the very high costs. So I think we will hear from it right now. So the next speaker is Mr. Märten, Deputy Secretary General from the Ministry of Finance. And you have been quite long with the Estonian pension system issues throughout your career, so I think it's a very good place to be here, including the central bank when you were a deputy governor in 2000-2011, so it almost feels like home here. Okay, the floor is yours.
Yes, thank you. Home sweet home, right? Parachuters. Sten, one of my brothers had a few years ago experience that within a few weeks he had first jump with a parachute and first time meeting a bear in the forest, and I asked what was worse, and he said that bear was much worse than jump. So you're right that that jumping should be removed from the list. So dear colleagues, having some thoughts retrospectively on second pillar about the changes Minister will enlighten us after me. About the second pillar, it's maybe worth to first go to the deep, what was the aim, and what is the aim. And there are, of course, slightly different versions how to define it, but if you look at the start of the process and also think of the logic, then primarily the aim of the second pillar is to contain pay-and-you-go systems' fiscal burden, i.e. alleviate so-called demographic risks. And this is, I think, important to stress because from the start it wasn't a separate pillar from calibration point of view. From calibration point of view, it has always been the part of the, first and second pillar has been analytically taken together. And then, of course, it means that it has compulsory element. Compulsory element to create savings for old age
pensions. I come back to the word pension into my last slide, but here I stress the word compulsory, and it has had influence on regulations. There are, of course, also other arguable aims of the second pillar supporting capital market, even depoliticized pension system, what sounds really ridiculous today as an aim. Somehow the second pillar has become actually more politicized than the first pillar, so what is quite interesting. And also, it was to increase the private involvement in basically in the first pillar, you could say it this way. This compulsory is indeed important because I claim that fair amount of the question whether it was over-optimized from regulatory point of view comes from compulsory nature of the second pillar. Because it was relatively logical, a compulsory element leads to relatively heavy involvement in regulatory side. For instance, numerous elements are taken care of, or at least intervened in regulation what regards the investment objects, investment instruments, asset managers, etc. Some more or less, I mean, some elements are a bit regulated, some are more regulated, some are less regulated. Just to specify that, or to underline that, there is a lot of care introduced into the system that I claim again is very much linked to the compulsory nature of the scheme. If it's compulsory, then you also have responsibility to intervene. That's the way how logic has gone, I would say. It also shows up in some other elements that would have otherwise probably missed in the let's say, if it would have been just tax incentive for savings, for the savings pillar, like requirements on depositories in your asset management, like the introduction of guarantee fund into the second pillar, what is cost at the end of the day. On the other hand, of course, you could claim that it should show up also in implicit return, at least, if not explicit return. And during the years, of course, you also saw relatively frequent meddling in a regulatory environment, including with fees. Again, if it would have been voluntary and just tax-based pillar, I would claim that there would have been much less intervention. With the second pillar as a compulsory element, it created more intervention. I don't count all the interventions because most of you know and have views on them. On the other hand, as a second pillar was and is the way to introduce private involvement in the first pillar in a way, then there's obviously been also counter-arguments that there has been too little intervention. There has been calls to have more intervention into the system. Because at the end of the day, the system has been functioning in a way where those who collect their compulsory pension rights have actually had very, very large choice for investment, freedom of choice. And a bit different question is what has been the supply, but in principle, the choice has been very free. It includes also relatively broad and even broadened freedom to switch, for instance. What by definition has repercussions to the liquidity requirements. So if there would have been more intervention, then maybe there would have been less requirements for investment liquidity.
relatively little intervention has been, or no intervention regulatorily has been into the investment process from the point of view of politicization in terms of asset allocation. Also, actually, a relatively free system. And one of the maybe most controversial things in our system, but actually that was designed to stress the responsibility of the private person in the process, was the way how the initial draw of those who don't choose the pension fund was built up. I mean, as you know, we built up in a way that the first, if you didn't choose the pillar fund, then you had a draw, but you were drawn between most conservative funds. Partly in order to induce you to make your actual choice. You could always claim that this was, it has changed now, and you can always claim that this was a naive element of freedom into the system. All in all, I would claim that if you take this too much optimization question or too little optimization question, then there's no problem to have multiple cases of high return but low risk syndrome in our regulation or regulatory discussion at least. So to have in the same sentence requirement that your returns have to be high but low risk is no problem at all. What is actually quite normal in the system, that is trying to solve multiple purposes with basically one or two tools. I will give you some examples of the performance from different angles, maybe with some comments. We have never had a formal benchmark for the system. Just there is one option to describe potential benchmark. This is basically 50-50 bond stock index. And here to describe a few things. One is that if you talk about politicization of assets, that more Estonian investments are needed, etc., then actually we had a early stage where we had bad experience with the Estonian assets. What not to say is that maybe it was simply too early, and took time to find the right domestic assets to have good investment. We had also a temporary suspension of contributions that was a bad timing in that sense that from the return point of view it would have been good time. Of course, there were other arguments why this was done, etc. And then actually what's most interesting part is between 12 and 15 roughly, because after that, if you think in terms of growth rates, they are roughly about the same. Again, no much difference. Is the time where it was actually a system that generated overly conservative investment portfolio with ex post knowledge. Of course, ex post knowledge was that we somehow should have been more or less risk averse. We should have been taking more direct investment risk, but we didn't. And it was, at some point, deliberate choice both of supply and demand. So that from regulation didn't that much influence that decision. There were some arguments that maybe regulation should have been more, let's say, risk-prone, etc. But at the end of the day, for instance, in this spell, it wasn't regulation that really constrained the ex post result. And interesting, what has to be stressed in the performance is that the performance, this is there are all present funds have been listed and their returns from the beginning. It's not academically very coherent picture because there are funds that have started from different times, but simply to point out that the fact is that inside the system there has been relatively high return funds and relatively
low return funds. This includes, of course, the most conservative funds that have been really constrained to invest only in low yielding but low risk bond structures. And if you combine now these two pictures, is that you could claim that it was fair amount of system's own choice what was the result, not necessarily that the regulation per se restricted or somehow prescribed. What is obviously question from exposed point of view that whether that level of choice was actually needed in the system or not. On the other hand, as we know, choice is the basis for the wisdom. Another illustration of that is how people have chosen their funds from, again, let's say, simple risk metrics. Let's say, the more equity, the more risky. It's obvious that, again, with exposed knowledge, of course, the choice of the, let's say, funds should have been different in some cohorts at least. Sorry? Years. Okay. Years are those who, they are birth years. It's 1 year choice of the funds by people who are born at that year. So let's say it was, I think, 2017 picture. There should have been much more. What is the color? Reddish. I don't know, or yellowish, or what is it? And as I mentioned, it is also interesting result because switching has been relatively simple. Relatively is again, of course, relative terms because it's relatively simple compared to many pension systems where switching is very much prohibited. Of course, if you have, there were still limitations on switching. And if you think that about 10% of people have switched per year now in later years, there was a change in the system, that's why there was a peak. Then I think it's still quite a lot, actually. But of course, if you look at the details, then you could say that the switching itself is relatively concentrated among some group of people. Yeah. And finally, a picture on the fee structure. There has been a lot of meddling into the fee scheme. There was some abolishment of some fee elements already 10 years ago. Lately, we basically abolished all the elements and except management fee. That has been now also reduced quite heavily, mostly due to the links with the size of the system, but not only. What is maybe interesting also to recall in this picture is that fair amount of meddling into the system was related to the transparency of the data. Of course, you can always say that even now the transparency would have been better, but to alternative investment allocations of private persons, the transparency is incomparably better. I mean, there is an unbelievable amount of those claiming that they know what they compare, but actually they don't compare. And finally, a few words on actually pensions. We have been talking all the time about pensions, but not actually talking about pensions. Pensions are regular old age payments until your death, not something what you collect when you are young. And actually the compulsory nature of the system also reflected in the pension side, I mean the outcome side. And one could say that in that part, the behavior market failure is actually even worse than in the collective part. That, let's say this way, that people in 30s or 40s, they might be almost okay answering to the question how much you should have pension rights when you turn 65 or something. But then you start calculating that how much it returns if you really count your expected death time, then the things become much blurred. And, but there where maybe regulation really didn't reach yet the better part, because when now the second pillar is turning less compulsory, then we anyway have to give up the pension part of the regulation. That's it from me. Thank you.
So we've learned about the regulator perspective, and right now Mr. Kristjan Tamla, CEO of the Swedbank Investment Fund, but also from his experience in doing research in various aspects of pension systems in both public and private sector, will tell us about the industry perspective.
Thank you very much. Thanks for inviting me, and thanks for giving the opportunity to talk on behalf of the industry. In my short presentation, I'll try to cover two broad topics. First of all, the outcome and results of the second pillar over the past 17 years. And then I'll finish up with potential implications on investment restrictions, what the planned changes to the system might bring about. There are many different ways of analyzing and comparing the performance of the pension system. I try to look at it from the two angles. First of all, from the fund's performance angle, which was partly already covered by the previous presentation. But secondly, I'll try to cover also the topic where I compare how those people who did join the second pillar 17 years ago, how their financial outcome has been relative to the ones who did not. To start with the performance of pension funds, the one where industry has a big impact on, then the average return since the introduction of the second pillar has been 3.7% per annum. And over 17 years, the pension funds have managed to generate real return of 10%. This is the, so to say, performance perspective from the fund management side. Now, turning to the perspective of joiners versus non-joiners, who are better off today, who can expect higher pension, whose financial assets are larger, whose financial liabilities are lower. First of all, one can compare who can expect a higher pension upon retirement. A person who did join the second pillar 17 years ago, or a person who did not join the second pillar 17 years ago. The difference to those two columns comes mainly from two sources. First source is slightly different contribution rates. The people who did join the second pillar in this calculation, they have contributed roughly 1.71 percentage points more over the 17-year period. And the second difference comes, of course, from the difference between the performance of second pillar funds and the indexation of the first pillar. And one can see that irrespective of the income level, people who did join, so to say, the average pension fund 17 years ago can expect today slightly higher old age pension versus those who did not join. The other way to look at it is to compare the financial balance sheet of people, those who did join and those who didn't join. And the next two charts, these are based on the Swedbank client data Swedbank has roughly 40-45% market share, and I believe that this is pretty representative of the whole society. The question has been that have second pillar savings or compulsory second pillar, has it crowded out any private investments or private savings? At least based on the Swedbank client data, if we compare people or if we analyze people who are close to their retirement between the ages of 55 and 63, then one can see that irrespective of the income level, the gross financial assets as well as the net financial asset position of people who did join the second pillar is better versus those who did not join. So at least my conclusion is that the introduction of the compulsory savings element has not crowded out any voluntary savings. If anything, people with the compulsory savings element have also had a better voluntary savings behavior than those who have not had the second pillar. And perhaps sort of unsurprisingly, what one can derive also from the previous chart is that if one looks what people with what kind of income level do have the highest share of their financial assets in second pillar, then it's pretty obvious that those who with the lowest income levels do have the highest proportion of financial assets also in the second pillar. So second pillar savings is by far the most equally distributed financial asset category, at least among Swedbank clients. And if one looks at this chart, then can see that for low income earners, mandatory second pillar investments are almost the only source of their savings, what gives them exposure to the developments of financial markets, and as such also diversify their future pension from local business cycle developments. This brings me to the next topic, fees and costs of the system. It is of course very tempting to compare the relative or absolute management fee rates across different pension funds, different pension systems across different countries. However, as with the performance, different comparisons can often lead also to very different conclusions. One thing what seems to be clear is that larger pension systems tend to have also, on average, lower management fees. There is a negative correlation between the size of the pension system and the fee level in that system. So larger pension systems, lower fees. However, this relationship does not seem to work linearly. If one compares what is the total amount of fees charged across pension systems, then one reaches a totally different conclusion. Larger pension systems do charge also much higher total amount of fees what the smaller systems do. To continue with the costs and different requirements on asset managers, it was touched upon already briefly in the previous presentation. But the point what I'd like to make is that throughout the existence of second pillar, those 17 years, the mandatory cost level, or what I call is the license to operate, the costs for the license to operate, these are the costs which are almost out of the control of the industry, but which are required to pay, have been relatively high. In certain years, they have even been about 20 basis points. Just recently, they have fallen somewhat. The second thing I'd like to highlight here is that the different equity requirements, what asset managers have faced, have been by far the highest in the asset management industry. It was, again, briefly touched upon in the previous presentation, that it is probably due to the compulsory nature of the system. However, one might ask that maybe our system has been a bit over-guaranteed, and maybe very high equity requirements have actually created entry barriers and have prohibited the increased competition in the industry. As said, I'll finish up with the potential investment implications of the planned system changes, and I do not really dare to say what will be the effect on the assets or the total assets of pension industry once the planned changes are being adopted. However, what I think is that once the first dust is settled and people behaving on the first emotions have made their choice, I think that the second pillar funds will become pretty similar to the ones what we see currently in the third pillar, meaning that the liability side of second pillar becomes more or less similarly liquid to the fund which is to the ones which is currently in the third pillar. And perhaps sort of the best insight what could happen or what kind of impact the planned changes could have to investment policy is when one compares how second pillar funds versus third pillar funds, how they invest today into the low liquidity instruments. And one can say that at least when it comes to the two biggest asset managers, Swedbank and LHV, these are also the ones who have by far made the biggest investments into low liquidity instruments. The difference is roughly half in relative terms, meaning that second pillar funds today have invested into instruments with high liquidity premium around 25 or slightly more % of their assets, whereas third pillar funds invest close to 10%. Big part of those low liquidity investments are made into the instruments related to Estonian economy. And if I would give a ballpark estimate, then my ballpark estimate would be that even with existing asset size of the second pillar, if the liabilities would become similarly liquid to the third pillar, then the investments to local economy would, instead of 600 million euros, be roughly 300 million euros, without any impact on the total asset side of the industry. What kind of projects are most likely to lose out? Quite often, the liquidity of the investment is not 100% related to the liquidity of the final underlying asset. Often the liquidity of the investment is also related to the structure, how this investment is being made at. Take, for example, a core real estate commercial building in Tallinn. I think it is a semi-liquid instrument. It is almost always possible to find a buyer or a seller to that instrument, maybe with the exception of 2009. However, if you make that kind of investments via the structures or vehicles which are, so to say, commitment-based, where the pension funds write out commitments and the managers, specialized managers, make the investments throughout the next several years, then that kind of structures or selling your shares in that kind of structures is probably increasingly difficult. One example I can give is in 2007, 3 Estonian second pillar pension managers committed exactly 20 million euros to Baltic Infrastructure Fund for infrastructure investments. The duration of this fund is 20 years' time. With a fully liquid nature of liabilities, I personally do not see how that kind of investments can be made also in the future if the liability side of funds is as liquid as that of the third pillar. With that, I'll finish. I thank you all for your attention.
Thank you very much. We've heard the concerns about the pension system, regulator and industry perspective, and right now I would like to invite Mr. Märten, the Minister of Finance, to summarize the concerns with regards to the functioning of the pension system and also present the reform proposals. The floor is yours.
Thank you. Good morning, everyone, and thank you for inviting me. I do have to say that I can't be here all day, and I actually even do think that I have to skip the debate because I have to be in the... I didn't know that when I told Madis that I was coming, that there will be a government's security-related meeting, so-called COBRA, which, by the way, discusses money laundering and a certain death of a certain ex-banker. So I have to give you my presentation and then run away, and someone else will have to hold the fort in defending their reform. I sometimes do get the feeling that people are trying to still fight over a battle that is already being fought. The reform of the second pillar has been decided by the government, and the law is almost ready to go to the parliament. So I think I call upon people in investment world and in banking sector to think about the ways to adapt to it instead of convincing themselves or the public or the politicians of how bad an idea this is. It won't really change the course we're on. I also, with the utmost respect to Mr. Hansson, I disagree with the fact that we're vandalizing the system. I think, entirely honestly, there are people in political circles who would like to see the entire second pillar done away with entirely, and who wouldn't really mind if the entire system would go out with a bang. I'm not among those people. I have to say, I think that I think one of my most important jobs in course of this reform is to make sure that the system will not freeze or fall over, but will work as intended, and the reform will work as intended. So what is it intended? I think the philosophy behind the reform of the second pillar, or actually it is not just the second pillar, it is more or less the entire pension system that we're reforming. Because it has a very big impact on first pillar as well, and we all understand that once we are on our way to reform the second pillar, we will have to do something about the third pillar as well, because it will make no sense to have a second pillar and a third pillar which are two lookalikes. So what is the aim of the reform? The aim of the reform is flexibility and freedom of choice, and it also is what we are hoping to achieve out of it is to give a better regulatory framework and a bigger market impact in order to push the institutions to give a better return to the investors. And yes, I have to say, the leaving of the money from the system is not a bug, it's a feature. We currently estimate that somewhere between 1/4 and 1/3 of the money already accumulated in the second pillar will leave. The bigger bulk will be sort of front-loaded, but it will not happen all at the same time. It will be sort of a wave in once the opt-out is possible, and then a sort of steady, slower stream afterwards. But there is an important element that people sometimes forget or do not take into account is that, as we saw in one of those previous, actually in both of those previous presentations, we do know that our first pillar is more or less an egalitarian one. I wouldn't know how to say it, whether it punishes people with higher pay or helps people with lower pay or something in between, but it levels out your earning once you're receiving the state pension. The second pillar, of course, is exactly the opposite, or should be exactly the opposite. So people who are at the moment outside of the system do have, first of all, the opportunity to join with the system, and also I would say they do have motivation to join with the system. So it's not just an opt-out for anyone who is in the system. It is also an opt-in. And let's see what comes next. I did see this presentation today already. So there are a few things that are basically entirely new to the system, and one of them is the personal pension investment account. Now, the best way to describe the personal investment account, pension investment account, is it is a one-man's pension fund. It has the same rules where to invest, how to invest. It has the same rules of opting out or withdrawing from the fund. It has the same rules as changing your fund. You can go from personal pension investment account to any pension fund that you choose with the same rules that already exist in changing your funds. And it has the same treatment on the tax side as well. So for all those people who say that they think they would be better investors than banks, there is a possibility to try it. Also, of course, as I said, a feature, not a bug, is the option to withdraw your money from the second pillar entirely. And in that case, your second pillar ceases to exist. You can do it twice in your lifetime. There is a default position that once you're 18, you will automatically be added or joined to the second system, and anytime you want, you can opt out from that. From that moment on, a 10 years cooling off period will start, and you can't join the second pillar before 10 years time has passed. Then, whether it's the 10th or the 12th or the 13th year, you can again join the second pillar, which will be the last time for you to choose that. And then once 10 years has passed again, you can then, for the last time, choose to leave the second pillar. So you can basically opt in and opt out twice in your lifetime. Also, you can as told, you can withdraw your money, and if you do that, if you withdraw your money before the pension age, you will have to pay income tax, which currently stands at 20%. Also, you can in the future, the payment is different once you're in your retirement age. It will be more flexible. It can be regular payments or annual payments from the pension fund directly. It can be a contract with insurance company, and it can also be a lump sum once you're in pension. What's the difference between lump sum before the pension and after the pension? The difference is income tax. The income tax before the retirement age is full 20%, and the income tax afterwards is 0. So the timeline is such. We are a few weeks away from presenting the law to the Parliament. We are working on the assumption that the Parliament will be able to vote it into a law before the end of the year, before Christmas. We will then, of course, enter the unknown world of whether the president will actually sign it or not, but that's a risk. Let me say like this. We work under the assumption that someone will challenge the law in court anyway. So whether it's the president or someone else, it really makes no difference. The next year will be the time to make this necessary changes in the IT systems of the banks and the IT systems of the state. It needs system changes in tax agency, also in pensionikeskus meil inglise keeles on? Pension center, which is a bigger headache. And starting from the 2021, the outpayments will start. So it is a reform that will take roughly 1.5 years to go, and we see the outpayments 3 times a year. It will be the same dates and the same system that will right now exists on changing the funds. So it will keep the system as simple and as people are used to it as possible. What else? A few points I wanted to make about. Let's see if I have something. No, I don't have anything here. I am well aware. Let me just put it like that. I'm well aware that it will impact. It will impact the investment side. This is the most important part that I think we have to work on. That it will impact the investment side, and the investment environment in Estonia will change after the reform. But I do disagree with the notion that this is a reform that's been done by politicians who want to get their greedy hands on a very big sum of money. This is much. Has much more to do with ideology or the understanding of how people's responsibility for their own old age and for their own sort of investment or use of their own money should be free. And I again return to the point that the first pillar is more egalitarian, and the second pillar is, along with the third pillar, is more in tune with your income. So we are working very hard to make sure that and I don't think that the banks or the funds or investors are actually trying to create some unease or panic. I do believe that comes from political landscape more. But I don't think that we should take it as too easily, but I don't also think that we should be panicking. This is a reform. This is a very big reform. This is one of the biggest reforms, not just for this government, but for the Estonian social and welfare system and economy over the past, I'd say, 15, 20 years. And we do want to get it right. As I said, let's say about a quarter of the money will leave the system. But once that has happened, we do believe that the system actually will be more agile and more productive, and will start working for the Estonian economy. So I've been in contact with the interest groups and with different banks and with the finance inspection and all sorts of people, and I always ask the same question. I don't want to hear that don't do it, but what I do want to hear is what are your proposals to making sure that this reform will work smoothly and give the result that we want. So that's it for me. Thank you very much, and I wish you a productive day. Thanks.
Thank you very much. I don't know if we will have all panelists in this panel staying for the questions and answer session, or Mr. Minister is leaving us, unfortunately, but I understand that there are others that will take over. We have 20 minutes for questions and answers. And I think after all those presentations, there's a lot of questions that come into your mind. So the floor is open right now. And there are microphones, so people who would like to speak. First, I would like to invite the panelists, yes, to come here. And let's start. Who's, here you go. If you could introduce yourselves. And there are microphones around, so. And we will select a few questions and then I will come back to you, okay?
Yeah, thank you. Andreas from Finance Committee in Parliament. First of all, thank you for the presentation. I noticed that Minister left already, but just a statement of the fact that yes, the decision is made at the level of government, but the Parliament will most certainly have a thorough debate on the reform proposals, so that we will promise from the side of opposition at least to make the things really better. I have a question to Mr. Ehrlich. You mentioned that when the reforms of the first pillar were discussed, they were all made in assumption that the second pillar would continue to exist in its present form. With the knowledge that the second pillar may be in a different shape, what you would reverse or what you would have done differently, and how it all helps to the sustainability of pensions, and maybe what would be the answer to the chart what Kristjan Tamla showed, where those who joined the second pillar actually have accumulated higher pension rights than those who didn't join. Thank you.
Thank you very much. Other questions? Over here, and then...
Yeah, hello. I'm Kristjan. I'm one of the pension fanatics who, let's say, not friends with the second pillar system. And my question is that we don't argue that so far it has been quite catastrophic, the system here. A little bit better than Nigeria, as we saw. But my question is, there are a lot of reforms that we could do to make the second pillar system better, and that's what the proponents have always said. But I ask that there is a theoretical limit to how much we can enhance the system while still having it obligatory. So what's the limit there, and is it theoretically possible that the second pillar will grow faster than the first pillar? Thanks.
Thank you. Cheikh, Anta, Gueye. The microphone is coming from the other side, I think, behind the... And there are mics here, so if our...
Okay, I think Märten and Kristjan, they presented the performance of the second pillar, but it seemed to me a little bit descriptive. Can you provide this overall assessment of the performance in terms of return of the system? Second pillar.
Thank you. And there is one more over here.
Aivar Sõerd, Member of Parliament, Member of Finance Committee. I have a question to Märten Ross. After the reform, people who leave the second pillar can independently start investment. My question is how many active investment accounts we have today, and I expect the number is some 20,000, like that. You have exact figures. What is the forecast? What is the expectation of Minister of Finance? How many private active investment accounts we will have after the reform? How much is the increase of in the number of individual person investment accounts? Thank you.
Thank you very much. I think we've gathered a handful of questions, so I will pass to you to answers, and then we will have a second round if time allows. So, Mr. Ehrlich, I think you were the first with the question.
So, just to clarify, what I said was that when we made the reform of the first pillar of the pension system, the fact that there was a second pillar that is dependent on your income was an argument in that debate. It was an argument that said that even though we reformed the first pillar, we make it less dependent on incomes, there's still an element in the pension system that remains dependent on wages to fulfill the second purpose of pension systems, to give you an adequate income in your retirement compared to a salary before retirement. And now this might change a bit. I do not really have an answer how much it's going to change, because this depends very much on how the reform is going to pan out. What is going to be the share of people who are going to leave the second pillar system? What is going to be the share of people who are going to join the people? But anyway, I think in a few years, at least, we have to look back at the reform and then think again about our first pillar. So what I can promise you is that in 2021, we're going to publish a report on the adequacy and sustainability of our pension system in order to give an answer to this question. What kind of reforms are needed in the first pillar? But I think before we actually know what's going to happen, it's hard to say what is the right thing to do right now. But thank you for the question.
And would you like to address other questions on the performance and?
I think
but I think it's maybe to yeah.
Sten?
Yes, I think it is.
I'll try to answer first the question regarding the performance of first pillar and second pillar and what is the theoretical limit. I think this issue has been debated now a long time locally, and I haven't fully really understood the nature, how this debate has really started. I think it's two things what people are a bit missing here, is the total capital share in the economy, if one takes the GDP side from the income perspective, and the stock market part of it. The stock market is only part of total capital in the economy. And I think the best guide what we have is the past. If one takes almost any developed or even I think developing economy over the past 20, 30, 40 years, then I think almost in any country stock market return has been higher than the nominal GDP growth. Stock market is not the full capital in the economy. No, absolutely no. No, this is not the conclusion of that one. The second question was, I think, by head of the mission regarding the assessment of the performance of second pillar. I think the first assessment was actually shown on the slide by Märten, that the returns have been very diverse across funds. It has been possible to be invested in a fund where the return has been well above the average, and it has been possible to be invested in the fund where the return has been well below the average. If I compare the asset allocation differences of Estonian pension funds as compared to major, or let's say the old OECD countries, the old EU countries, then the biggest difference what I often see is the size of low liquidity instruments. It seems to me that the liquidity premium has played much bigger part in the performance of, so to say, old EU or old OECD member countries' pension funds and pension industry than in Estonia. I think there are some rational reasoning for that, some is maybe irrational. I had also a slide which showed how the legislation on low liquidity instruments has changed over time. And the ones who paid close attention to that understood that until, I think, 2015 or 16, the possibilities to invest into low liquidity instruments and to reap the liquidity premium were fairly small in Estonia. After that, the restrictions have been loosened from year to year, and we are now in a position where the low liquidity or the size of low liquidity instruments in pension funds portfolios has more or less doubled over the past 4 years.
Thank you. I think it's...
Yeah, okay. Oh, yeah, okay.
Yeah, there are nice people over there that manage the microphone.
I know
so
we are all nice people, aren't we?
of course.
I'll take first the question of Mr. Sõerd about the investment account. As Minister also hinted, what we have is, I would rather say, scenario predictions based on recent questionnaires that how much people might be willing to withdraw and not. So, but there is still more than a year to go, and the way how people will behave over next year, I think, is unpredictable. It depends on how, among other things, how political decision makers will sell these changes, etc., etc. But on this investment account side, I don't think that the present level of investment account holders is a very good prediction of the outcome of the so-called pension investment account activity. And I should also clarify that from, I would still claim that if you switch between the second pillar funds and the pension investment account, then you actually don't leave the second pillar in the new system. I would guess that most who leave the second pillar don't actually switch for the pension or investment account as well. I have the gut feeling that those who leave the second pillar with money, they have mostly other incentives and motivations than to turn to personal investment. And then I would basically claim that if there is a reference to 1/3 leaving it, let's say that is a working assumption, then I would rather say that this 1/3 essentially returns to the first pillar, not so much to the investment account. So I would be inclined to claim that the number of pension investment accounts might be actually higher than the present reference to investment accounts. Depends at the end of the day, of course, also on how technically easy it's actually, etc. One more, how to say, problematic questions of Cheikh and Kristjan about the. I understand that kind of personal assessment of the results of the second pillar so far. I would leave this question whether the second pillar can return higher returns than the first pillar to somebody else, because we have discussed it eternally. I mean, there's no single answer to that in my mind. But at the end of the day, I would, with the pros and cons analysis, etc., and particularly taking into account that the fundamental aim of the second pillar was to relieve the first pillar from the, I mean, as I put it on the slide, to contain the fiscal cost in the future. Then the result actually has been still okay. I mean, you could be critical on aspects, etc., but for instance, these questions whether the intervention has been overly heavy in terms of cost, for instance. Well, we don't know, of course, what would have happened otherwise, but at least what we know that over these 15 years, the system has been free of major or even minor, I would say, let's say systematic faults or something. We tend not to, of course, count this as a return for the society at the end of the day. From return point of view, I have very strong personal doubts whether this choice was actually good to be given to the public. But on the other hand, the other side of me says that basically, what I think it was if from return point of view, there were a couple of major arguments that for instance, over these 15 years drew the difference between systems outcome and the benchmark. A fair amount of it was either deliberate choice of or let's say knowledgeable choice of asset managers, or at least semi-knowledgeable choice of the pensioners. With ex post knowledge, we could say that actually there were a couple of relatively poor decisions from return point of view. Now, is it simply bad luck? Are we, as a society, not able to have better returns? Or we should have had more, let's say, regulation in order to steer the result? There I have to say that I'm split exactly in half. One half of me says that, yes, you should have been telling those people that don't be so stupid. The other side telling that, well, that's exactly the choice. It could have been also returning better. At the end of the day, return has not been, with combination of this relative system safety, has returned, I think, minimum at least, what was required.
Okay, we still have a couple more questions here.
One final comment.
In the second round. I'm sorry, we are like 3 minutes till the coffee break, so I will still a couple of minutes from the coffee break, but then as there are some other people that would like to ask questions.
Andre Güüsek, I'm heading the capital market development at the EBRD in London. I will leave my questions relating to the economic impact and perhaps resilience and competitiveness of Estonian economy to the second part of the workshop, and would limit my question here to this panel to the level of the individual. What I have learned in my career in the financial sector, which includes serving at the boards of several pension fund management companies in Europe and Asia, is that to successfully invest you need two basic things. One is know-how, the other one is diversification. Hence my question to the government representatives here, and I will split the burden. Maybe Sten, Andreas can help me on the financial literacy issue. How do we, in the coming 2 years that we hear is left for the individuals to start investing their own money, increase significantly the financial literacy of the population? And then secondly, Märten perhaps can address the diversification issue, given that the median amount on the pension account of an individual is below 5,000. How would you diversify? Thank you.
Okay. Governor?
I suppose my question should have been addressed to the minister, but since he left, so I think Märten and Sten Andreas need to do their best. But
that's the privilege of the ministers.
actually,
they leave and...
The minister, I think, said a few interesting things, for example, on the taxation from the second pillar. He promised that there will be incentive from once you take money out from the second pillar in your after reaching retirement age, that it will not be taxed. I don't know if that has been announced previously, but I'm glad he's looking for ways to make the second pillar more attractive still. But since he also said that he agrees it doesn't make sense to have two voluntary pension saving pillars, the second and third, next to each other. So my question is, either at the Ministry of Finance or the Social Affairs, what exactly are you planning to change in the third voluntary pillar in the draft law that I think we expect in a few weeks? Thank you.
Okay, and a very short, because you had your chance earlier, so a short question.
Sure. So how do you prove that the second pillar system actually has increased savings? As per Eurostat's data, the mean savings rate both in countries with second pillar and without is 20%. And also Estonian Bank has shown us that people with the second pillar and without them, otherwise the same, their net profit, their net assets are exactly the same, although the people without the second pillar system have paid 4% more tax into the first pillar. And the second part is based on
and I think
Ministry of Finance, the incoming payments into the second pillar will be lower than the outgoing payments from the second pillar, not before 2056. So as far as that, we're having second pillar only as a cost to the pension system. Is that calculation right, or how do you comment? Thank you.
Any other questions? The final one? I have one question which regards people with low income. We've seen that actually the distribution of pension savings is pretty equal across different income levels. Have you considered the scenario of people who have low income, they decide to withdraw from the second pillar, so their pension savings will be lower, how it will be compensated in the first pillar, if it will be compensated, and what are the expected outcomes with regards to one of the issues that were mentioned in your presentation, particularly Mr. Ehrlich, on the poverty risk of people with low wages in the future. So what are the distributional consequences of the proposed reforms? Okay, the floor is yours.
So perhaps I'll start and I'll try to address three questions. So first about financial education, then secondly about what's going to happen with the third pillar, and finally about poverty. So about financial education, I think this is an ongoing project, a project that has been happening for many years already, to increase the knowledge of people about their finances. I think it's hard to imagine how to achieve big changes in a span of 2 years, because usually skills take a lot longer time to be established. Of course, you could say that the reform as it is right now, all the attention we're turning towards it, is already contributing towards financial education, because people will, or financial literacy, because people will pay more attention, and this is something that is necessary. But I think this is not where the true answer lies. The true answer is really in how do we build up the system. So how are you able to submit your application, to take your money out? What are the forms for it? Is it possible to do it in a shopping center while you're running to get milk from a supermarket or not? Is it a requirement that sound advice is given to you or not? Who is going to give you sound advice? So I think things like this are really what's going to matter if people are going to make rational decisions or not. And this is something perhaps we should debate more on. Given that this reform is happening, how can we build the incentive structure so that people are going to make rational decisions that are going to leave them better off in their retirement? And how can we avoid people taking their money out, making decisions, simply thinking about the short term? And even if financial literacy is not going to be the answer, there are other resources for that. Second question about the third pillar. I'm not entirely sure what the minister had in mind, but something that we were discussing about the third pillar is how to make it more attractive for essentially occupational pensions. So something I talked about in my presentation was what to do with these special pension schemes for certain professions. And one possible answer that many Western European countries have taken is that even though the state does not guarantee you a special pension scheme for these hazardous professions, your employer does it for you, essentially in a third pillar form. One possible change is that we incentivize more companies to contribute to their employees' pension schemes. That may happen either through even bigger tax breaks on them. For example, there's no social tax break right now for the third pillar contributions for companies. It might be in the form of changing the regulation, how you get to these kinds of agreements. Perhaps there should be a possibility for you to get there through a collective agreement, things like this. I think these elements will not be included in the draft law that's going to happen, or that's going to come out in a few weeks. Instead, we're trying to negotiate these changes both with the employees' organizations, employers' organizations. So this is the course of future actions. The final question was about poverty. I think probably the reforms in second pillar are not going to affect the poverty rates too much. And the reason is that for the people whose incomes are rather low, the share of the pensions that they get from the second pillar is rather low as well. For them, the first pillar is as it is more solitary, it is bigger as a share of their income. And therefore, I think poverty is not really that big in this discussion. Rather, I think the question is about adequacy rates and those for people with higher income rates.
Mm-hmm. Okay. And very short reactions to questions.
I have more questions, but time is up. Maybe I pick only two ones that can be answered more shortly. On the diversification, Andre, obviously this new system would be exposing private persons to higher risks than the pure second pillar fund system. But, well, new brave word, right? Why not? And to answer this poverty risk issue, the questionnaires have so far given somewhat surprising result that the reaction vis-à-vis withdrawing from second pillar is actually rather even. It doesn't really reflect the specific social patterns. But we'll see. I don't think so. My personal guess is that if there is a notable influence on pension rights, accumulation of the middle income or lower middle income future pensioners, then it will show up in the discussions regarding the first pillar tax rates in the future.
Any last reactions?
Okay, yeah, to finish up, first of all, I was very encouraged to hear what the minister said regarding the potential tax incentives to keep the savings until the retirement, that there is planned 0% income tax for withdrawal after the retirement age. I think it is indeed sort of one encouragement which could preserve the system in a better way. Then trying to address the two questions I was able to write down. One is the second pillar effect to savings. I think it boils down really that whether mandatory savings do crowd out the voluntary ones or not. And I think on the national level it's almost impossible to say. And I think even in a cross-country comparisons, we don't have a very clear-cut answers. However, from the individual level, which I also highlighted, was that people who do have second pillar or who have the compulsory form of pension savings, then their financial behavior has also been better versus those who do not have. People with a second pillar do have higher financial assets as well as higher net financial assets, meaning assets minus liabilities. And the second point I was able to write down was something related to inflows versus outflows. That is it, yeah, yeah. If you would take out the word compulsory and just think that it's a voluntary savings investment industry, how an industry or the framework where the inflows exceed outflows should be negative for the society. It is a bit hard for me to understand this concept.
Okay, so I think it will be for a coffee break discussion between you to understand. We will have a very short coffee break of 10 minutes, but before that I would like to thank our panelists. We have, I think, a very good start.